Hello everyone and welcome to today's webinar where we'll be taking a look at mandatory greenhouse gas emissions reporting. My name is Stephen Kennett and I look after the built environment and energy portfolio here at 2 Degrees. I'm delighted to welcome our presenters from Carbon Clear today. We have Mark Chadwick, CEO, and Stuart Lemon, Head of Advisory. Today's presentations will last around 30 minutes, which will leave us with 10 to 15 minutes for questions at the end. During the presentations, we'll be running 2 polls. These will appear in the right-hand panel of your screen, and all you need to do is select the most appropriate answer, and after 30 seconds, we'll be sharing the results with you. Before we begin, I'd just like to remind everyone that you can submit questions throughout the webinar using the Q&A box on the bottom right-hand side of the screen. Just type in your question and press send, and then we'll wait till the end before answering as many as we can. As an aside, if you should have any technical issues during the presentations, please use the chat box on the right-hand side to send me a message, and I'll get back to you as soon as I can. So without any further delay, I'd like to hand over to Stuart, who'll get us started with today's presentation. So over to you, Stuart.
Okay, Stephen, thank you very much. Hopefully you can hear me. Welcome to everybody that's joined the webinar this afternoon. Topic for the day is mandatory greenhouse gas emissions reporting. It's also known as mandatory carbon reporting. We're not going to dwell too much on the definition, but we are going to dwell on the detail and the content of what's involved and how to reply and respond to the regulation. Just so that you know who that you're listening to, we've got myself, Stuart Lemon, the head of the advisory team here at Carbon Clear, my colleague Mark Chadwick, who is the co-founder and the CEO of Carbon Clear. And in real life we are in full colour, not in black and white as you see us there. The agenda for this afternoon, and we're going to try and keep it fairly punchy to allow plenty of time for questions at the end. I'm going to give an update on mandatory greenhouse gas reporting, the basic details of it, who it applies to, what it involves, when it comes into force, and how to respond. And then I'm going to hand over to Mark, and he's going to take you through our 4-stage approach to responding to the reporting requirement, how to develop an action plan, and get onto the process of complying with the regulations. Very briefly, before I go into that, just an introduction to Carbon Clear so that you know who that you're dealing with and who you're listening to. We're a carbon management and sustainability consultancy, been around for about 8 years, headquartered in London. We have operations throughout the world, predominantly in the US, Spain, Turkey and India. We've got about 30 staff, of which 20 are based here in London. We describe ourselves as a fairly small but multidisciplined team, quite highly experienced in anything and everything to do with carbon. And that involves CRC, carbon disclosure project, responses and improving scores around that, obviously mandatory greenhouse gas reporting, and we get involved more and more with large clients looking at strategy, developing and implementing carbon accounting systems, stakeholder engagement, and further and further into the supply chain and supply chain management. Grown pretty quickly in the last few years, and we've got some fairly significant experience in large and small organisations. Our sort of strap line is that we are very, very keen to help our clients to deliver commercial value from carbon management. All of the people here are absolutely committed to doing their bit to fight climate change, but we very clearly understand that for businesses to invest in it, it needs to add some value to the organisation. We are members of IEMA. We currently hold the presidency of ICROA. We're accredited CDP providers, and in fact one of our bits of work has recently been nominated for an award in the ED Sustainability Leaders Awards, which are coming up shortly. Anyway, that is a brief update on Carbon Clear. Obviously, if you need to know more, you can contact us later, find us out from the website. So in terms of mandatory greenhouse gas reporting, who, what, when and how? From the delegate list that we've seen for the participants today, we know that there are something like 100 people listening in, and we know that a reasonable number of those come from PLC organisations, large corporate organisations, and they are the key target for mandatory greenhouse gas reporting. But what I will highlight through the next few slides is that we believe in the future it's likely to expand in scope in terms of who will be required to respond, and therefore I think it's fairly relevant for any reasonable sized organisation to be taking an interest in the regulation. So it's implemented as part of the Directors Reporting Regulations, and specifically called the Greenhouse Gas Emission Directors Report Regulations 2013, which is a rather snappy title. As I said before, also known as mandatory carbon reporting, because it's mandatory and it reflects carbon, obviously, and is a new requirement for UK industry. Just as a bit of background, it was first developed as a campaign by the Aldersgate Group, who successfully lobbied for inclusion of the consideration of mandatory greenhouse gas reporting in the Climate Change Act of 2008, and since then it's slowly worked its way through consultation into Parliament and now is a statutory requirement. So in terms of who then, the legislation, the regulation applies purely at the moment to quoted companies. Those organisations that are incorporated in the UK, i.e. formed and registered at Companies House, and the significant thing, the important defining factor, is those whose equity share capital is officially listed on the main market of the London Stock Exchange. And that applies to around 1,100 companies in the UK. But if you are UK incorporated and also officially listed in another EU area exchange, such as the Paris Exchange or the Deutsche Börse Exchange, you can be required to respond to this, as you can be if you are UK incorporated and listed on the New York Stock Exchange or the NASDAQ. Those are the specific listing requirements, and we believe about 11 to 1,200 organisations will be required to respond over the next 12 months. But the guidance suggests that this is best practice for all companies and that all companies should consider reporting their greenhouse gas emissions. There is also a hint through the consultation process that this will become a requirement for all organisations or large organisations in the future. The regs are subject to review in 2015. And that could bring in large organisations into mandatory reporting, at which case the number would expand to anywhere up to around 20,000 organisations. So just as a sort of quick poll for the people listening in, we have a question here, which Stephen's opened up for us. We'd be very grateful if you could just respond by clicking the appropriate box on what sort of organisation you represent. Are you incorporated and listed and already fully compliant with mandatory carbon reporting? Are you listed but sort of yet to comply, i.e. you're beginning to address it? Are you a private limited company or are you another company? We're going to leave that poll open just for a few seconds while you select the appropriate response. Okay, I think the polling time has now closed and hopefully we'll get an answer through shortly. I'll continue while we do that. Excuse the background noise. We have a very busy road outside the front of our office and we get a little bit of background noise coming through. Okay, so if we then look at what is going to be required to be reported, the key phrase in the guidance documents are that a company must report the emissions for the activities for which the company is responsible. That's the key phrase. And that's broken down further to be activities for which you have the power or the direct control over the extent to which greenhouse gases are emitted. Now, for those of you who are sort of familiar with defining control within organisations, either for financial purposes or for other carbon or environmental related standards, you generally have a number of options, either financial control, operational control, or occasionally some other form of bespoke control definition. The guidance provides no specific requirement for a control approach to be taken. All it says is that you have to have the ability to direct the relevant activities. The caveat to that is that you should bear in mind, obviously, that this is part of the Directors' Reporting Regulations. The Directors' Report typically sits within the published financial accounts for the organisation and therefore will be audited as part of the financial accounts. So if you choose a control type that is not financial control, there is a possibility that there will be a discrepancy between your accounts and your carbon footprint, in which case you'll need to explain that, but I'll talk a little bit more about that in a minute. In terms of what you'll need to report, this, I think, is one of the most significant bits of this. Lots of organisations have been reporting footprints for some time. We have a number of clients who've been reporting UK footprints for many years. The regulation requires all sources of emission globally that you are responsible for to be reported, and that includes any subsidiaries, associates, leases, tenancies, JVs, etc. It can also include other equity investments. Now, this is potentially quite a complex area. I'm not going to go into it today, but you do need to bear in mind where your organisation has an equity investment in another organisation, and you will need to understand whether that means that you have a controlling interest in that company. Because if you do, then potentially you have the ability to direct the organisation and therefore have an ability to control the emissions, and therefore they need to be reported. So that's a consideration that's worth bearing in mind. In terms of what you need to report, then effectively it's all of the 6 Kyoto gases, and I've listed them there. We also believe that nitrogen trifluoride will follow when the Climate Change Act is amended in 2016. That will be in addition to the 6 that are already stated. The report will require that you provide information on all of the fuel that you combust, buy and burn effectively. And for those of you familiar with sort of the terminology of carbon footprinting, that's broadly the Scope 1 emissions. And that will include the operation of any facility. So fuel can be from a stationary source, such as a generator or a boiler, but it can be from a mobile source. So it could be a plane, it could be a train or a ship or anything like that. But the extension includes any facility, so that could be a mobile facility, a temporary facility. If you are a construction company, you have temporary site facilities where you are powering generators, forklift trucks, site equipment. You will need to include those, and it can be marine-based, so it could be oil production platforms, processing platforms, etc., etc. The other thing to bear in mind if you are a manufacturer is that you would also need to include process and fugitive emissions. Typically you will be sort of conscious of those and probably reporting them through another process anyway, such as your environmental permitting, but again needs to be borne in mind. So that covers your Scope 1 emissions. The final point on this slide is around the reporting of electricity, purchased goods and services, or in terms of electricity, heat for steam and cooling that you consume. And this was effectively energy that you are buying, typically in kilowatt hours or a similar unit, which will need to be converted into carbon emissions and reported alongside your fuel-related emissions. Those broadly follow the terms of what we know as Scope 1 and 2, and what the regulation doesn't include is Scope 3. So things that are outside the reporting boundary of your organisation won't need to be included at this stage, but it's possible that in the future mandatory reporting could be extended to include that. The next slide looks at what you actually need to report, so a summary of those emissions, and for those 6 Kyoto gases you will need to calculate the emission as the equivalent tons of carbon dioxide and report that, but you're not required to look at supply chain, and you're not required to look at the end of use phase of products. So if you supply cars, you don't need to look at the fuel that the customer puts in them when they drive them off the showroom, or the energy required to dismantle and recycle the vehicle. The other key question and requirement of the regulation is that companies are required to report at least one intensity ratio. An intensity ratio is a measure of how much carbon you emit per unit of activity. Now, there's no clear guidance on what intensity ratio you should choose. It is entirely up to you. All it states is that you must provide one. Typically, most organisations choose to provide intensity as a function of turnover, but you may find for whatever reason that that's not appropriate for your business and you want to choose something else. You may also want to choose to present 2 or 3 to give yourself a bit of wiggle room. You should also consider the materiality of the information that you're giving. One of the key bits of the guidance in terms of reporting is that it's very clear that if you omit or misstate information, that could be influencing the decisions of the investors in your business or other individuals outside who are reading the director's report, then that is a clear sort of breach of the regulation and could cause problems for you later on down the line. If we look then at the timetable for this, the regulations were introduced post-consultation in April. They became law very, very quietly on the 12th of June, no great big fanfare, and they go live at the end of September. So any organisation reporting on or after the 30th of September this year will need to provide its mandatory greenhouse gas report in the following report that's issued, and we'll look a little bit at the timetable in the next slide. In future years, you will also need to present a comparison to the prior year, but obviously as this is the first year and there's no prior year against which to compare, that's not a requirement this time around. So the following slide presents the breakdown of typical reporting years and when the first reporting year is for your organisation. So if we take the middle one of those, which is probably the most common reporting year, that's the calendar year, 1st of January to 31st of December. Any organisation with that reporting year who falls under these regulations will need to publish its mandatory greenhouse gas report in its next published report, which will be probably at the end of the first quarter of next year. And obviously the implication of that is you will have needed to collect the appropriate information and data right from the start of January 2013, which means that we're already 9 months into that data collection period. So there's a certain amount of urgency around gathering that information, even if your reporting year isn't ending until December. In terms of then the how, as we said previously, the regulations are made under the Companies Act 2006, and they've been updated to include specific guidance and regulation around the Director's Report, and that is where the information will need to be located. And it will be presented in a format that has been mandated in the guidance and effectively presents those bits of information that we've discussed. It won't, at the moment at least, be audited in the same way that the financial statement is audited, but the auditors will consider it for consistency with that financial statement. And there is some degree of sort of materiality on the part of the auditor, who will be able to consider whether the mandatory greenhouse gas statement is consistent with the financial statement. And if that auditor, he or she, notices that it's not compliant, they can notify the management. If the management choose to do nothing about it, they can refer it up the line, and it could go to arbitration. It is unlikely at this stage, but it is a possibility. So it is worth making sure that the information in there is correct and accurate and consistent with the consolidated accounts. There is a slight threat, I guess, in the last point on that slide, in that the Companies Act does say that directors can be jailed for fraudulent statements in their director's report. So if you are struggling to get board-level buy-in for investment in doing your mandatory greenhouse gas reporting, that is always the big stick that you can wave if you feel you need to. So that's basically the nuts and bolts of the regulation. Summary of it really in those 4 points. Who does it apply to? Well, it's UK incorporated and listed organisations. What is covered? Well, all Scope 1 and 2 activity to be reported in tonnes of CO2 equivalent. Applies to any organisation whose financial year, reporting year, ends on or after the 30th of September this year, and it will need to be applied in the Director's Report in the approved format that's specified in the guidance. So that's basically it from me. I'm going to hand over to Mark now, but as I do that, I was just going to ask this question. Given that mandatory carbon reporting is in place, and given that it may well change in the future, do you think that this will drive behavioural change within your organisation? Yes. You think it does? No, because you're already there and comply? No, because you don't believe it's important, or you don't know. Thank you very much for your time and attention. I'm going to hand over to Mark now, and then I'll join you again for questions at the end.
Thank you very much, Stuart. It was an excellent summary. I think the poll is now closed, so we can move on to the next section. By now, I guess some of you on the webinar will have formed a view as to whether or not you will be required to comply with the legislation. For those of you who have formed that view, it may well be that this is a new activity or a project. And what we're going to do now is just talk through our approach for getting companies up to speed with carbon management, which is applicable to mandatory greenhouse gas reporting. And an obvious first step when you're taking on a new project or a new kind of activity really is to prepare your plan of action. So the first 2 points, I think, are obvious in your plan of action. The first thing is really to assess your inclusion. If you, following that exercise, determine that you're not going to be included, then congratulations. If, however, this turns out to be something that does impact you, then probably the second thing on the list is to make sure that those senior investor relations, finance people, company secretary, etc. in your organization are aware of it. This kind of surprise usually doesn't go down overly well, so it's a good idea to make sure that there's as much information sharing inside your organization as you can. Now clearly there are other items on your action list, and really the question as to what they are really does depend on quite a few different factors. It depends on your aspirations as an organization. It depends on where you are in terms of your carbon management to date. So I think there are a number of key questions that we would ask, and I suggest that you should also ask inside your organization to begin understanding where you go and what you're trying to achieve. So initially, perhaps some questions that will help you establish the nuts and bolts in terms of operationally what needs to happen. So key questions like, do you currently report your carbon footprint? Clearly that's going to be a very large driver in what your ending to-do list looks like. If you do report your carbon footprint already, is it appropriate for the rules of legislation, or is it going to take some work? If it's going to take improvement, what needs to be improved? And I think importantly, it's worth thinking now about who needs to be involved in this process and when they need to be involved, so that you can set internal expectations. No one's going to appreciate being asked for a year's worth of energy data a couple of days before the deadline. There are a number of other questions that we suggest you should also think about that are perhaps more strategic in nature. Things like, what are my ends in mind here for this legislation? What am I trying to accomplish? And we'll talk about that a little bit more in detail as we go through this process. And perhaps another question is there an opportunity here for me in my role to drive some change in my organization? Is this a driver for my company to pick up carbon management if they're perhaps not doing enough today? So to help organize all these questions and actions, we've put together a simple 4-step process. And broadly, it looks like this. What I'm going to do is I'm firstly going to summarize the 4 steps, and then we'll dive into detail about each of the steps, just so that we can really establish a firm base of understanding about what needs to be done. The final thing I'm going to do in this session is have a look at a sample timeline and hopefully illustrate some of the urgency of getting on top of this particular issue. So the first step in the process, the initial assessment phase, is about figuring out where you are now and where you want to be. And there are a number of questions and considerations to think about here, and we'll get into this section shortly. Once you have your initial assessment done, we then need to start making a detailed plan. So you've established where you are today, you've established where you want to be. Now it's about working out what's required to get me from one state to the other. Once we've done this work, we understand what needs to happen to calculate and validate my carbon footprint. The next step really is about putting the core numbers together and, crucially, making sure that they are right and that they meet the requirements of the legislation. The final step of the process is about producing the report, producing your emission summary and getting it into the director's report. This is likely to require some significant work with internal stakeholders, with the external assurance providers, and really to make sure that your organization is happy to sign off the report that you've prepared. So that's the top-level summary. We'll now take a look into more detail at the 4 steps. So initial assessment. I mentioned before that it's important to think about what your ends in mind are. And that idea may not be immediately obvious to people, so I've included a few examples of what we mean by ends in mind. It could be that for your organization, simply complying with the legislation is as much as you're aspiring to. And that's a perfectly adequate response to a new piece of legislation, of course. It may be that you see an opportunity here to drive some internal momentum. You can perhaps escalate the conversation around carbon and emissions reporting all the way to the top of your organization, and maybe this is the first opportunity for you to do that. You could be looking around at your competitive set and trying to work out what they're doing and making sure that whatever you put into the public domain doesn't embarrass your organization in any way. That can be from a perspective of perhaps your reporting not keeping the same level of transparency as your competitors. It could also be something as basic as your carbon intensity being higher than your competitors. And in any case, it might make sense to find out what that's going to look like before you get too far into the process. Some organizations will see this as an opportunity to take a leadership position in terms of transparency. Probably and realistically, these will be organizations who are already doing a significant amount in terms of carbon management, or perhaps organizations who sit in an industry where there is very little awareness of carbon. So some of these ends in mind may be appropriate for you, some of them may be out of reach. But it's important to understand what you're shooting for before you begin the process of detailed planning. Next stage in the process is to really begin to understand your organizational boundary, and Stuart talked to some of the considerations there, so I wouldn't go into that too much. What I would say is that even the very large organizations that we work with, many FTSE 100 companies who have a very strong established track record in carbon reporting, are still failing to meet the requirements of the mandatory greenhouse gas reporting legislation. Sometimes that's because their reporting boundary doesn't match with their consolidated financial reports, often because they've got a different geographic view, maybe they haven't considered joint ventures and other elements. Getting this right is key, because this is one of the things that your auditor is required to check. Required to check for consistency between your consolidated financial report boundary and your footprint boundary. Once your boundary is established, then you need to understand which facilities, assets, etc. produce emissions and which emissions you are responsible for. Finally, it's important to think about footprint methodology in this stage. We've got a range of choices in front of us. The legislation does not require you to choose one particular methodology, but it does recommend that you choose a robust and accepted method. And it gives a few examples, such as ISO 14064 and Greenhouse Gas Protocol. These are certainly the industry leaders in terms of carbon footprint methodology. So if you haven't already begun your process of carbon reporting, you would be well advised to choose one or another of those approaches. So the output from your initial assessment is a sort of a requirement specification. So what are my business objectives? What do I need to report? What have I already got in place? And it's the beginning of your process. So let's take a look at the next step. You now know what you need to do. The key question next, of course, is do you have the data, the processes and the systems to allow you to achieve what you need to achieve? The first important question here is, does your current reporting match against the requirements? If there is indeed any current reporting. If it doesn't, where are the gaps? So if you're perhaps only reporting for the UK and you've got operations in other countries, that's a clear gap that you will need to close before you submit your report. The next point, will the quality of my data keep me awake at night? Now this is an important consideration. There is a material difference between sustainability reporting, which is essentially voluntary and is a communication tool which supports your branding and positioning, and a director's report, which is a mandated part of listed company requirements and is legally mandated. The level of scrutiny over those two documents is probably quite different. The next thing to think about really is what do you need to do to make sure you can sleep soundly? And one of the things to consider is verification of your emission statements. It's not required by law, but of course everybody's confidence level may be improved materially if you were to consider verification of your emission statement. So the output from this stage of the process is a gap analysis. What needs to be done from our current state to our compliance, to being in a stage where we can comply, and a real definite plan of action. Now we get into the meat of it, which is really the calculation and the validation. This is about putting the plan into action. Step number one, implementing process improvements. So this is about closing gaps. When we say implementing process improvements, it may indeed be the case that it's creating processes for organizations who aren't currently managing their emissions. Perhaps you might want to consider implementing new systems or even a sustainability reporting software package. Larger, more complex organizations may indeed decide that software is necessary to operationalize reporting. Now that this is a mandatory requirement, by the very nature of the beast, it will have to be done every year, and it will be in the public domain where your investors and other stakeholders can see it. So you may feel more comfortable having a system to help you manage that. Gathering global data, stage 3. Here, data should be sought from all companies and facilities identified in step 1 of this process. If you can't find data, that is okay. It is acceptable to estimate data that you're missing, but those estimations really should be based on sound and defensible approaches. And I think it's significant and important that they should be clearly explained in some basis for reporting document, or a governance document as we often call it at Carbon Clear. Step 4 is about calculating emissions. What you've done in step 3 of this process is you've been gathering activity data. Activity data, for those not familiar with carbon accounting, means things like how much electricity am I consuming, how much diesel am I burning in my fleet, the various emission sources that Stuart referenced. Calculating emissions is a rather simple process once you have that data. It's about selecting an appropriate emissions factor, and these are provided by authorities such as DEFRA. You multiply your activity driver by your emissions factor, and hey presto, you have your carbon numbers. So that in itself is not complex. Really getting the data and the systems and the processes together is where the complexity lies. The calculation of emissions is relatively straightforward once you've done the first bits correctly. Point number 5, about identifying and calculating benchmarks. These are the intensity ratios that Stuart referenced earlier. There's a surprising amount of thought and discussion goes on when we work with organizations to identify intensity factors that really do speak to their organization. It's very important that you find an intensity driver that properly links to your business performance and your business activity. If you do this well, when your business grows, your intensity factor will compensate. Your business grows and your carbon emissions grow. Your intensity number will allow you to reflect that business growth in your carbon reporting. If you get it wrong and they're not connected, you could end up looking like your carbon emissions are increasing significantly and you will not be able to explain why. So this is quite important. The final step is quality assurance and verification. As I said, not necessary, but we've discussed this before. It may just help you feel more comfortable about what you put in the public domain. So the output of this process is completed, probably quality assured greenhouse gas statement that everybody in your organization feels comfortable putting their name to. Finally, after all of the work you've done and the fruits of your labor need to be included into the director's report. This sounds like a fairly trivial step, but I suspect for the first time in many organizations it will be slightly more fraught than you would first imagine. First thing really is to agree the form of the report. So the guidance document is quite clear on the minimum that you need to require, but when we refer back to the ends in mind that you may have defined, the minimum may not be good enough for you and you may need to go further. If you want to go further, there will no doubt be some negotiation between yourself and the company secretary or whomever else is responsible for the report to see how much space they will let you have. The next thing is to agree any supporting narrative that will accompany the report and the reported data. This will be driven primarily by your basis for reporting. So where you've made estimations or perhaps where you've excluded parts of your organization for some reason, this is your opportunity to explain why, and indeed the legislation is set up on a basis of comply or explain, and so those explanations are very important. You then need to draft the report for inclusion in the director's report and get sign-off. This is likely to include a whole range of stakeholders that, if you haven't been involved in the director's report before, you may not have had to deal with. So you may end up having a greater degree of interaction with your company secretary than you have hitherto, your corporate affairs people, your finance director, and maybe even non-executive directors who also have to put their name to the director's report. It makes sense, I think, to begin to understand who those stakeholders are well in advance of actually trying to agree that report for inclusion. And then we think about assurance. It may be required by your company secretary. If it's not, and in any case, the overall director's report will be scrutinized by your auditor before it is signed off. And as we mentioned before, they will be looking for consistency between your consolidated financial statements and the greenhouse gas statement that you're making. One final point or word of caution, just to remember that in many organizations, preparation of the director's report has a long planning horizon, often involving many stakeholders, including external communications agencies, and so early planning is advised. So just to wrap things up, I want to take a look at a sort of sample timeline and piecing all the things we talked about into a mini project plan, if you will. This timeline theorizes a reporting year that runs from January to December. A financial year that runs from January to December. In this scenario, we would expect that you would be producing your director's report sometime around the end of Q1 2014. And this will be the first director's report that will require the mandatory greenhouse gas statement. So if you are able to get started on this initial assessment as soon as we're done with this webinar, then we can think that the process starts in September of 2013. You would need to go through the initial stages of this process up until the point at which you have implemented your system, identified your data providers, started to build out your calculation methodology, and started making friends around the organization, all well before the end of this year, if you're going to have a reasonable chance of meeting the deadline. So we are looking at, in reality, initial assessments being completed, gap analysis being completed, building your systems, identifying your data providers, making friends, calculation methodologies, all of that before you break for Christmas, which is about 4 months. That isn't a long time in reality, particularly not if you're a large and complex organization, even more so if you're an international organization and you need to do your relationship building across national boundaries. Come January, when you close your financial year, you would then need to begin gathering data. And you need to gather data covering the period from 1st of January 2013 to the 31st of December 2013. Once that data is gathered and added into your calculation methodology, You will start to produce your greenhouse gas numbers, which will then need to be QA'd to make sure that everyone in your organization is comfortable. I think significantly, it's worth remembering that January 2014 is also the beginning of the 2014 reporting cycle. So as you go through the learning process of establishing who's going to report data to you and how you're going to pull it together, you might want to think about how you would improve your process for 2014 as well. Finally, your compliance reporting period. I don't know what your internal deadlines will be in this scenario, but I think it's worth, given the relatively short time frames, finding out who in your organization is responsible for the director's report and finding out from them now by what time they need this director's report statement from you. It will almost certainly require a number of weeks for internal processes and assurance. So all in all, I think a busy 4 months up until the end of the year, and possibly an even busier 3 months from January to March for any organization who isn't currently reporting their carbon footprint. So that brings us to the end of the 4-step process, and we can now switch to Q&A.
Fantastic. Thanks for that, Mark, and thanks, Stuart, for that overview. So yeah, we'll go straight into the Q&A session now. And Mark, maybe we'll pick up with this one first, if you could maybe just clarify. But one of the questions that's come in is how much time is available for submitting a report after the finish of the company's reporting year? Is there a specific deadline?
Yeah, thanks for that question, Annette. The answer to that question will lie with your company secretary or whoever is responsible for the director's report. So it is the director's report that sets the timeline for this particular compliance objective. When your director's report goes out, it must include that greenhouse gas statement. Normally speaking, organizations tend to put them out within 3 months or so of the end of the financial year, and it's really driven by investor requirements. They want to know what your organization's carbon performance has been in the prior year. So we can't give you the answer, but you really should speak to your company secretary or maybe even finance director, and they will be able to tell you by when they need it.
I believe there is a statutory deadline for FTSE-listed organisations to publish those accounts. I don't have that exact date to hand, but I think what I'd add to Mark's answer is that it is unlikely that your directors, company secretary and finance director will delay the publication of the report to wait for comprehensive data on the greenhouse gas emissions. So you need to potentially prepare some alternative strategies whereby if you haven't got complete energy data that matches up with your complete financial data, you may want to consider offsetting the year which you report your greenhouse gas emissions for, or you may want to consider extrapolating to fill the gaps in the data that you've had. Both of those are acceptable approaches as long as they are clearly adopted strategies and explained within the supporting narrative to the report.
Sorry, one thing Stuart said there may not be clear to you, to everybody on the call. By offsetting the reporting year, I think what Stuart's referring to is it's not necessary to report exactly the same year for emissions as for your financial report. So you could report a different year as long as you explain why.
Thanks, Mark. Another question following on from that. Someone's asking, is billing data acceptable for electricity and gas rather than the actual meter readings?
Yes, absolutely fine. Ultimately, the requirements of greenhouse gas reporting are not as stringent, let's say, than perhaps CRC would be. So we're really looking at, Sandy, I think we're looking at for your organization, it's about providing a credible estimate of your greenhouse gas emissions that is materially correct. And as Stuart said in the beginning, the materiality part's important. It's really about making sure that you're not saying anything misleading. So the only time when I might urge some caution is if you know that your meter readings are significantly more than your billing, and you're reporting billing instead, and thereby giving an artificially low version of your carbon footprint, then I might urge some caution. But if they're broadly in line and they, on an annual basis are about right, then they're absolutely fine as a basis for reporting.
Great, thanks, Mark. Someone else is asking, how well do you think ISO 50001 meets the compliance reporting requirements?
I think, to give a slightly vague answer, it depends how the ISO 50001 system is set up. It's an international standard for energy management, and it is intended to drive energy reduction and greenhouse gas emission reduction. So if the organisation that's implemented it has set it up to include all greenhouse gas emissions, then it will provide very useful data for complying with mandatory greenhouse gas reporting. My concern would be, without seeing the specific system, that some emissions that are potentially material, and the example I'm thinking of is one of our clients who manufactures refrigeration units, who prior to some work we did to them had a very significant proportion of their total tonnage of CO2 equivalent emission due to fugitive losses of refrigerants. In that instance, those refrigerants would not typically be covered by an ISO 50001 energy management system, so you could potentially be under-reporting. So I think broadly the answer is that yes, it will be a good starting point, but you would need to assess whether the 50001 system included all of the elements that you had control over and all of the activities that you were undertaking.
I think I might be slightly more categorical than Stuart on this, and I'd say it isn't appropriate really. It is a standard designed for driving energy management and energy improvement in organisations. It is not a standard designed for carbon accounting. And so you might be able to use it, but it's not designed for that purpose. So I would not recommend it to any organisations really. I think the data that you assemble while complying with ISO 50001 may be very useful. I think that's fair to say,
yeah.
But it is not a standard that is designed for the purpose of carbon accounting. Therefore, I would not use it. I would use a tool that was designed for the job.
Yeah, I would agree with that. Yeah.
Great. Thanks, Mark. Someone else is also just asking for some clarification. But, Mark, I think you mentioned that no control method has been dictated in the legislation. But the person's asking, they were under the impression financial control was what is to be used. Could you just clarify that?
Yeah, this is a really tricky one. It looked like for a long time the government was going to mandate financial control. And many of the briefings prior to the guidance coming out were very much steering people in that direction, including briefings by the CDSB and other people who are involved in the legislation. In the final analysis, that has not happened. There are some vague words about making sure that your carbon footprint reporting boundaries match your consolidated financial reports, but actually that's quite a different thing in many ways. What that's about is making sure that the legal entities that you're consolidating from a financial perspective can be identified clearly in your carbon footprint, or you're explaining why not. That's actually quite a different thing. So if you were to take an example of, let's say you're applying a financial control approach, you may determine through that approach that a certain company is within your financial control, and then you would, as part of the process of carbon accounting, go beyond that level to see the facilities and the other assets, and you may determine that a number of those facilities and assets are not under financial control, and therefore you may exclude them. So the two things really are not the same. You have the flexibility to choose a control approach that meets the requirements of your organization, and I think it's beholden on companies complying to just explain what they've done and why, and that will be adequate. So I think there was a bit of a mismatch between what was originally briefed and what finally came through in the guidance.
Great, thanks, Mark. Stuart, I don't know if you want to tackle this one, but someone's asking, how do you assess which emissions are material from a company's global operations without first measuring them?
Which is a very interesting question. How do you decide whether something's material if you haven't measured it? I think it's very, very difficult to do that, and I think my recommendation would be that you need to undertake some form of data capture and analysis to be able to determine materiality. I don't think you can take a view just based on guesswork. I think it's important to gather information, maybe not to the level of detail that you would want for your declaration and your director's report, but enough information on which to base a materiality assessment.
Right.
Yeah, I think that's absolutely right, but some of that data may be really easy to find, and you may be able to do it quite quickly. So there's a company that we've been speaking with for some time who have a very, very significant UK-based portfolio. They also have a number of operations in different countries, and they were able to see fairly quickly that while they might have tens of millions of pounds of energy spend in the UK, they've got a few £1,000s in their overseas locations. So it's fairly quickly apparent to them that those small overseas satellite offices will not make a material impact to their carbon footprint. So sometimes it's easy. You can do it with financial data. You can do it with electricity consumption data. You could even do it with floor area. You know, if you have 1 million square meters of floor area in the UK and 50 outside of the UK, probably you don't need to worry too much about the 50 outside of the UK.
Great, thanks, Mark. So I'm conscious of time, but I think we've got enough for a couple more questions. So one here, will a UK incorporated subsidiary, which is not listed, qualify for the MCR if its US incorporated parent is listed?
No, is the answer to that one. The definition is fairly clear. Quoted companies are those that are UK incorporated and equity share capital officially listed on the FTSE. So if the parent is not UK incorporated, then they wouldn't be included under these regulations.
Great, thanks, Stuart. So one final question here. If we don't have data from previous years, how do we present a comparison?
There is no requirement in the first year to present a comparator. So year one can be just a direct report on the greenhouse gas emissions for the year for the Scope 1 and the Scope 2. If you choose to present data for prior years, you're very welcome to do that, but in the first year there's no requirement to present the comparative year. Obviously, having been through the process once, when it comes to year two, you will have that information with which to provide a comparison. Great,
thank you, Stuart. So that's all we've got time for now, but I'd like to thank Stuart and Mark for their time today and for getting through so many questions, and also for everyone who's joined us for this webinar. Just to remind you, a recording of the webinar and the presentation slides will be archived on the 2 Degrees platform. So I hope you found today useful and informative, and that you'll be able to join us for further webinars in the coming weeks. So thank you.
Thank you.
Thank you, everyone.